Bond market liquidity is drying up very quickly here, and it could cause disruptions in the Federal Reserve's plan to drain assets off of their balance sheet. We've been hearing them talk about QT, selling assets off their balance sheet, unwinding aggressively and quickly, but all that could change if we have enough chaos start in the bond markets due to there being no liquidity. This means the Fed is left with two options on how to handle this. One of them would be using the reverse repo facility to handle this. The other one would just be to stop QT, reverse, and start up QE yet again. Ready? Let's dive in. Real quick word from today's sponsor, iTrustCapital. You guys know that I have used and recommended iTrustCapital for a very long time because you can invest in crypto using your IRA. And you can invest in gold and silver using your IRA. This means that whether you want to start up a new IRA and make new contributions to a traditional or a Roth, or whether you have money already in a retirement account that you want to roll over and use to buy gold, silver, or cryptocurrencies, you can do that safely, cheaply, and easily with iTrustCapital. And I'm serious when I say safely because they take security extremely seriously. They never take custody of your assets. They never borrow or lend against your assets. They never let their custody providers do either of those either. They also have an extremely straightforward pricing model. They do not have any monthly account fee. It's 1% for crypto, $50 for gold, and $250 for silver. Given the fact that cryptocurrency is in a severe bear market right now, many people are looking for ways to start buying the dip and getting in at the bottom here, but also people should be concerned about any tax implications that might come along with cryptocurrency gains later on should those assets be worth a lot more. Doing this within an IRA is the perfect way to shield yourself from those tax liabilities. If you do it with a Roth, any contributions that are made are taxed, which means any gains are not. In a traditional IRA, it is the exact opposite. And so IRAs are a fantastic strategy to avoid some of the tax implications you would have in a regular brokerage or a regular crypto account. And because they have assets like physical gold and physical silver available as well, this gives many people the option to invest in these alternative forms of money that normally you would not be able to do in a regular IRA or your 401k at work. So I'm a huge fan of iTrustCapital, using it for crypto, gold, or silver with your retirement money. And if you use my link in the description below, I've got a little bonus waiting for you as well. Right now, the Federal Reserve is both raising rates and selling assets off their balance sheet. If we take a look here at their balance sheet, we can see that over the past 10 years or so, every time their balance sheet has started to dip down, it hasn't lasted that long before it's had to go back up again. This was the longest period where it moved sideways. And then after the Trump election and the Tax Cuts and Jobs Act, there was room because the fiscal stimulus to tighten with monetary policy. So they were able to tighten into this. The market couldn't handle it. Plus there was no inflation. And so they decided to do not QE, which was raise the balance sheet yet again. And then 2020 happened, exploded their balance sheet, and now they're saying they're going to aggressively keep on winding down the balance sheet from here. Now, the problem with that is basically what's going on here is the balance sheet is large because they bought a bunch of assets, which is just another way of saying they loaned money to the government, but essentially they had to buy those loans as pre-existing loans from the market. So they created $2 trillion, went out to the market and said, hey, does anybody have any debt they want to sell us? We'll buy it. And so they bought $2 trillion worth of debt, or just about. And so the entire economy got this massive cash injection from everything that they bought. Now they've got a balance sheet full of debt. Now they're trying to sell that. Well, when you buy something, you give cash for it. Right? When you sell something, you take cash for it. So now they're going out into the market and saying, hey, we have a bunch of bonds that we want to sell. Does anybody want to buy them from us? So that's adding to the supply of bonds hitting the market. And there are dislocations starting. There's bond market illiquidity starting to happen now as the Fed is getting more aggressive with their quantitative tightening. This gets bad enough, they simply cannot sell because there's just no buyers. This was one of the problems that led the repo market to blow up in September of 2019 because there was just not enough cash in the system. So if the Fed sucks enough cash out of the system, then there's not enough buyers of the debt that they're trying to sell. You could have liquidity just cease to exist in the bond markets. That'd be a very dangerous thing for something that's supposed to be the safe haven asset, the United States government treasury, the most liquid asset in the world. So you might be asking, where did all that cash go when they initially bought those bonds in 2020? And we have to look right here at the reverse repo facility. This reverse repo facility, you can see, was not really used for the last 15 to 20 years. It was briefly used during 2014 through 2017 here a little bit, but apart from that, it wasn't really being used until in April of 2021 when the collateral rules came back in for banks. Now, basically what was going on here is cash is a liability. A deposit is a liability for a bank. They don't want it, but when they get it, they turn around, they buy an asset to offset that liability. Well, when $2 trillion enters the banking system, there's not enough collateral to go out and buy. So a lot of this cash then went into the reverse repo facility to get that collateral. Really, a lot of stuff you don't really need to understand there about the way the banking system works, other than this is where financial institutions park their cash because of regulations. That's it. So we've got $2 trillion of financial institutions parking their cash here. And keep in mind, this is pass through here. So this is technically your cash. This isn't just like the banks, their own cash. This is pass through. This is your own cash in bank accounts or in money market funds sitting here in the reverse repo facility. So this is important to recognize. When you go to your grocer or your broker to buy stocks or stakes, money comes out of the reverse repo facility into your hands. You spend that money, goes into somebody else's bank account, then goes right back into the reverse repo facility here. Whether you're pulling it from a money market fund or a bank account to buy stocks or stakes, that's what's happening here. And on net, there's not a lot of money leaving here because that's where all the cash is sitting, even when transactions are happening. So $2 trillion is waiting in here. And the reason why it's still waiting in there is because it's getting paid a fat interest rate for no risk. You can take a look at this chart here. You can see that through all of 2020, there was nothing being paid on reverse repo balances here. And then the Fed started to pay. As soon as they were jacking up interest rates, they have to keep it above the Fed funds rate here. And so now they're paying 2.3% here for any funds that are in the reverse repo facility. And this is risk-free. It's coming straight from the Fed. They don't have to worry about maturity. They don't have to worry about market risk or anything like that from buying T-bills. So this is straight up risk-free from the Fed. Of course, financial institutions are going to take advantage of that. So back to the bond market issue that we're facing. Bill Dudley on Bloomberg said that the reverse repo facility is probably going to do much of the heavy lifting as quantitative tightening continues. However, this presupposes banks will be happy to take on the extra reserves. And that's a big if. This is a big if because if they don't see lending opportunities, they don't want to do this. And banks probably don't see lending opportunities because they're currently tightening their own lending conditions. And so the assumption here is that as liquidity dries up, that financial institutions are voluntarily going to be taking money out of the reverse repo facility and going out into the market and assuming market risk with things like bills and bonds. I don't see that happening. Why would you do that? Which leaves the Federal Reserve with two options. Number one, they could just stop QT. They're selling assets off their balance sheet or at least letting what matures roll off here without rolling it over into new debt. But they could just stop this and let it move sideways or resume QT and start buying government debt again. They're still going to be tightening conditions by raising the federal funds rate, which you can see here they've already raised here and they will continue to raise. And as they do that, other interest rates will continue to move up as well. This highlights the fact that the main issue here is not government solvency. We're not looking at this $30 trillion pile of government debt and saying, oh no, rates are going to get too expensive for them to be able to afford. We are years away from solvency issues with the federal government's national debt. We're not worried about that with interest rates moving up. What we're worried about is there just being no lenders, liquidity drying up. They could come over here to their balance sheet and just stop selling assets off their balance sheet and let it move sideways for a while until liquidity conditions normalize or hope that they do. Now, personally, I don't think they're going to be able to do this either, because one of the main concerns they have right now is their legitimacy. It's restoring confidence in the fact that they can use monetary policy to achieve an outcome that they want to achieve. And within 6 months of starting QT, if they just stop or resume QE, all their credibility will be gone for anybody who still trusts in them at all. It'll be completely obvious that they've lost control of the situation if they stop QT this early on in the game, the fight against inflation. But very few people understand the reverse repo facility or the repo market or any of the other more complicated workings of the banking system. And so if they have to figure out how to solve the liquidity issue, it's not going to be with QT and it's not going to be with rates. It's, in my opinion, going to be with the reverse repo facility. But as Bloomberg points out here, that's a big if, because what if banks don't want to voluntarily pull money out of the reverse repo facility? Because like I said, they're getting paid 2.3% risk-free from the Fed. And on over $2 trillion, that is a fat chunk of money risk-free. So what can the Fed do? They can force the money out. All they have to do is start dropping the reverse repo rate so that it's below the Fed funds rate, or potentially can force it back down to zero. If they force that rate, let's say back down to zero all the way, then suddenly there's no return in there anymore. And you force all that cash out into the market to buy the bills, to buy the bonds. Yes, there's risk, but the risk is more than compensated for the fact that you're leaving 0% and going to something that's 2%. Which means that if people doubt the Federal Reserve's resolve to drain assets off their balance sheet because they're looking at bond market liquidity issues, they're looking at interest rates, they're looking at conditions getting too tight, people are not paying attention to the reverse repo facility. Conditions, as far as liquidity goes, can stay the exact same they're at right now as long as the Federal Reserve starts forcing money out of that reverse repo facility. That means they can drain close to $2 trillion off their balance sheet if they want to, while still allowing liquidity conditions to stay the same as they are right now. They can keep up the appearance of tightening because their balance sheet will be going down, interest rates will be going up, but liquidity conditions don't actually have to change because there's $2 trillion just waiting in the reverse repo facility to be pushed out into the markets yet again. Now, you know, if you've been following the channel for a while, that I've been talking about this reverse repo facility for a while because May of 2021 came around, money started flooding in there. I knew at some point they have the ability to force all this cash back out. Initially, I thought they would do it for political reasons to try and save the market, allow that money to go back in. We'd have a big crack up boom. We'd have a big boom in asset prices. But what I think they're planning on doing with it now is just saving it until the point where they need to use it to rescue illiquidity conditions where the bond market dries up so much that they have to force that back out so that they can continue to tighten without it actually affecting the functioning of the bond market. But as the facts change, my story will too. So as anything comes up on this front, I will let you know. As always, thank you so much for watching. You guys have a great day.